Hi, everyone. I'm Mike Sullivan, a partner in Orrick's Technology Companies Group based in San Francisco. Today, I'm here with Patrick Chung, a general partner at XFund, a venture capital firm. So thanks to everyone who's listening. And Patrick, welcome.
Thank you very much, Mike. So great to see you again.
So Patrick, I know you pretty well, but for our listeners, please tell us a little bit about yourself and what you do.
Terrific. Well, my name is Patrick, and I am general partner at XFund. XFund is the early stage venture capital firm that was spun out of Excel Partners, NEA, and Harvard University. We're an all early stage fund. So in 95% of all cases, we're the very first investors in the companies we invest in. About 40% consumer, 40% enterprise, 20% digital health. We have offices here in Palo Alto, California, and in Cambridge, Massachusetts.
Got it. And so far, it sounds like a lot of venture firms that I know. So how's XFund different from other VCs?
It's very different in, I think, really three different ways. Number one is that because we were co-founded by a university, we're really engineered to back and support university-based founders. We have this concept that we call tipping into existence, which is that there are very many talented people from the nation's best universities here and abroad who get recruited and who, when they graduate, have so many different opportunities. What we want to do is to make them aware of the entrepreneurial path. And so, if someone graduates from a Harvard or a Stanford and is recruited to join, Google or Goldman Sachs, that's a very solid, concrete offer. They have an actual offer letter in hand. What XFund tries to do is to actually give them a credible alternative in the entrepreneurial space so that when they graduate, in addition to having that offer letter from Google or Goldman, they'll also have a signed term sheet from us. And they still may decide to do Google or Goldman or grad school, but at least it will have been an active choice. And more often than not, when we provide people that we identify with that choice, they say to us, oh, gosh, I was just doing that thing because it was there or was easy to do. But my real passion lies here, and I want to go off and start this company. And thank you for giving me that credible alternative. So we've often tipped founders into existence. Number two is that we are having been, helped to be started by a large liberal arts university. We pride ourselves on backing these people that we call liberal arts founders. We live in a ecosystem right now, especially out here in Silicon Valley, that's very technocratic. A lot of venture firms will not even speak with you if you didn't major in computer science or engineering or some hard science. We will definitely, of course, back people who are computer scientists and engineers, but we also will back people who studied English and history and classics, philosophy. These are people who we believe are being systemically ignored by venture capital that we specifically target. And indeed, some of our very best companies, our most successful companies, have been started by people with actually no traditional technical background whatsoever. And then lastly, because we were co-founded by a university, because we were engineered to back people from university contexts, we really do have a double bottom line. And that's to say, yes, we are a for-profit venture capital firm, but also we have an educative mission. If a sophomore comes up to most venture firms and says, I've got an idea, most venture firms will say, get away from me, kid. You've got 2 more years to graduate. Come see me when you're serious. We don't do that. We will work with that sophomore for 2 years, again, to try to help her develop that credible alternative such that at the moment she graduates, she really does have a real choice. And so we will help educate that person, bring that person along in ways that other venture firms don't find it worthwhile to do. Got it.
So a couple of follow-up questions. I know you pretty well, but I did do a little bit of Googling about Patrick Chung and XFund before this started. So the fact that you're not afraid of classics majors or philosophy majors, I think that has led to some interesting results in terms of the diversity of your portfolio companies. Is that right?
Yeah, I mean, in terms of kind of what you're talking about is kind of educational background or educational discipline diversity, which we have a great deal of. But that also kind of reflects in some more traditional measures of diversity. So you may know last year, I think 2022, less than 2% of all venture capital dollars went to companies founded and run by women. About 1% of all venture capital dollars went to companies founded and run by Black founders and people of color. As against that, XFund's record really does stand apart. I think the last count that we did was 33% of our dollars have gone into companies founded and currently run by women, 52% by women and people of color, 72% by women, people of color, and immigrants. And that 72% of cost basis actually accounts for over 80% of the fair market value of the portfolio. So for us, at least, these groups have really outperformed.
Got it. Let's talk about what life is like as a VC. What do you really love about what you do? You've been doing it for a while, so you must enjoy it. What do you love about your job?
I mean, I guess the good things about venture capital are very evident to people. I think that's why it makes it so popular, especially amongst people who are graduating from universities now. It's really a privilege to operate in the markets in which we operate in Silicon Valley on the East Coast, to find amazing people who've developed amazing things, to try to understand what they're doing, and then to try to help them. I really analogize what we do to being not exactly artists, but the art dealers. We find artists. These are the founders who have these amazing visions, who want to make their visions come true in life. So you can think about them as like crazy painters who are painting. And what we do is we try to kind of understand the vision of the artist. We try to get that artist into the best galleries. We try to get that artist well reviewed. We try to sell his paintings. And if the artist is successful, then we are successful. But it really is a very different job from being the artist. Many art dealers have themselves picked up a paintbrush and painted, and some of them may have been very good at it, but they're actually very different skills and very different day-to-day jobs. And so instead of kind of painting the painting and being right there with them, we are really, how we view it is kind of, we're on the sidelines, supporting them, believing in their vision, believing in their art, and trying to make them successful. Got it.
What's a misconception about what it's like to be a VC?
Oh gosh, there are so many. A very good friend of mine, he had worked at Facebook, and then he worked at Google. At Google, he worked at search, and then he wanted to do something new. And I asked him, what do you want to do next? And he said, it's very simple. I want to work with smart people solving hard problems. And it was such a simple statement, but to me, it was really, as I thought about it, it was really, really quite deep. It has three elements to me: work with people, work with smart people, solving hard problems. And so the first misconception, I think, is if you're in a startup, you rise and fall with your team. When your product is successful, everyone is cheering. You're so happy together. If your product fails, you're all in the dumps together. You really have operated as a team. You've worked with people. In venture capital, you don't work with people in that same way. We have partnerships. We all have our separate portfolios, separate companies that we work with. We come together. But when my company goes IPO, I am so thrilled. I'm not as thrilled as the CEO, and my partners are thrilled, but they're actually not as thrilled as I am. And similarly, if my company goes bankrupt, I am really depressed, not as depressed as the CEO, and my partners are depressed, but not as depressed as I am. And so we really don't work with people in the same way that you do in a startup. So that's number one. Number two is, my friend said he wants to work with smart people. And, there's been a lot of hullabaloo in the market for many years, deservedly, about how insular venture capital is. There's been a lot of commentary about how not diverse venture capital is. And why has it not been historically diverse? It's because it's been, it's a very small industry, and it has been fueled by a lot of, honestly, nepotism. I'm in this venture firm because your daddy and my daddy worked in a bank together in the 1970s. And so therefore, you have very low representations of diverse populations. Sure, most venture capitalists went to good schools and they have fine resumes, but my friend, worked in the Google search. And in Google search, I mean, he worked with, these outstanding researchers, PhDs, truly, truly, truly brilliant people who were hired because of their brilliance and not for these kind of extraneous connections that are slowly disappearing from venture capital. And so I think one of the misconceptions is, I think, which is becoming less of a misconception, is that venture is not, has not historically been as meritocratically constructed as it might be. And then third, he said he wanted to work with smart people solving hard problems. At Google search, he had a very hard problem, which is that you are thinking about something in your mind, you type a few words into Google, and Google basically has to read your mind and give you the thing that was in your mind in link number one. That's a very, very tough problem. In venture capital, we don't solve hard problems. They're the same problem. It may be hard, but it's the same problem. Our companies may solve hard problems, but what we do is the same problem day in and day out, which is asset allocation. It's like you have a giant roulette table, you've got a bunch of chips, and you're placing a big pile on this number and this pile on red and that pile on black. And then the great wheel spins, and it spins very slowly. And the next fund, you're doing the same thing. And the fund after that, you're doing the same thing. So, for someone like my friend who had come from a place where he really was solving very hard problems, venture really did, he ended up going into venture, but then really discovering that he didn't like it for those three reasons.
All right, well, let's talk about founders for a second. We probably have some founders who are listening to this episode. Let's try to give them a nugget of wisdom. So a lot of what founders need to succeed, I think, just can't be taught. It's part of their DNA. But there's got to be some things that can be learned and worked on that will help founders succeed. So throw out a nugget of wisdom to our founders who may be listening about that.
Okay, I think I give prospective founders three bits of advice. Number one is that certainly many of the people that we work with, they've got options. When they graduate, they got high-paying job offers out the wazoo. And so the number one correlate to success is that you actually take the plunge. There have been so many amazing founders who could have been the next Elon Musk, Bill Gates, who instead became investment bankers. Who instead became consultants. And so number one is lawyers too, is number one, take the plunge. Number two, once you've taken the plunge, be incredibly persistent. Again, there have been many, many, many companies and founders that we've not heard about today. Why? Because they were almost about to succeed, except it just got too hard, or they thought they were going bankrupt tomorrow when they weren't. And they just, preempted and said to their staffs, okay, it's all over. We're leaving, pack it up. We're going home. The best founders that we've worked with and that I think exist in history go to bed one night, not believing, but knowing that they're going to go bankrupt tomorrow morning. And somehow they get up in the morning and they figure out how to survive another day, another week, another hour. And that's why we've heard of those companies. And number three, for the most part, having a great co-founder will radically increase your chances of success. Statistically, solo founders are just less likely to be successful. Now, there are many incredibly successful solo founders, Jeff Bezos, Elon Musk, but much more than that, choosing a good co-founder is going to keep you both, or keep all three of you or four of you or five of you stable through the rough times. And that, I think, builds resilience and ultimately persistence.
All right. I asked for one nugget and you gave us three. So that's fantastic. So we're a law firm after all. So let's I'm going to throw you a legal question. So what's some good advice that you've received in the past from a legal team that's helped either XFund or one of your portfolio companies? Any thoughts?
Yeah, once we had this great company that was actually founded. This was at NEA. We backed a company that was actually founded as a not-for-profit. And we, as the company, it was an incubator for healthcare startups. And as we continued to grow, our legal counsel said, if one day you want to convert into a for-profit, you should do it sooner rather than later, because later it's going to be a lot more difficult. And we listened and we thought, oh yeah, but it's all working the way it's working right now. Why don't we just forget it? And indeed, he was totally right, because a couple of years later, we thought it'd be better structured as a for-profit. I didn't really realize this, but a not-for-profit, I think you might correct me if I'm wrong, but a not-for-profit is technically, I think, legally owned by the government. And so when you convert into a for-profit, you actually have to buy back the entity from the government. And by that time, the entity had become a lot more valuable than it had been prior. And so we were actually unable to, or it became totally impractical for us to do what we wanted to and come from a 501c3 to a for-profit. And so I guess that's a lesson where you should listen to your legal counsel.
That's the takeaway. That's the takeaway I was hoping you'd drive to. Listen to the lawyers. All right. One more question. So it's April 2023, and we seem to be in one of those time periods where they come along every once in a while where it's tough to raise to get venture capital if you're a founder. Any advice for entrepreneurs in times like these where it's tough to raise venture money?
Yeah, I mean, this is an unusual time for the past 13-year-old bull market, but in history, it's not an unusual time. So from our standpoint, from a venture standpoint, it might seem trite, but the best, most enduring advice I could possibly offer is just simply build a good business. Because when you build a good business, you will not have trouble raising capital in high markets and in low markets. Obviously, try to operate as leanly as possible in environments in which capital is free flowing and essentially free. That will produce a type of kind of laxity with spending that I think is generally unhealthy. And then lastly, just that old adage: always be closing both on revenues and sales, and also on funding. So you should always be talking with your investors, keeping them tended and well-fed and watered, because when you need them, you'll want them to remember you.
All right. Good advice. So thanks to everyone for listening today. And Patrick, thanks for joining us. Hope we can do this again sometime.
Thank you, Mike. It's been a pleasure.